Hello, everyone. Today we are going to be talking about Chapter 21, which is capital budgeting and cost analysis. The objectives for Chapter 21, we will learn about capital budgeting and cost analysis. We have understanding the 5 stages of capital budgeting for a project, use of and evaluate the 2 main discounted cash flow methods, which are the net present value method and internal rate of return method. Use and evaluate the payback and discounted payback method. Use and evaluate the accrual accounting rate of return method. Identify relevant cash flows and outflows for capital budgeting decisions. Understand issues involved in implementing capital budgeting decisions and evaluating managerial performance. Explain how managers use capital budgeting to achieve their firm's strategic goals. What is capital budgeting and when must it be undertaken? Capital budgeting is working closely with accountants. Top executives have to figure out how and when to best allocate the firm's financial resources among alternative opportunities to create future value for the company. Because it is hard to know what the future holds and how much projects will ultimately cost, this can be a challenging task, but it is one that managers must constantly confront. This chapter explains the different methods managers use to get the biggest bang for the firm's buck in terms of projects they must undertake. Capital budgeting is the process of making long-run planning decisions for investments and projects. In much of accounting, income is calculated on a period-by-period basis. In choosing investments, managers must make a selection among multiple projects, each of which may span several different periods. There are 2 different intersecting dimensions of cost analysis. We have the horizontally across is the project dimension, and the vertically upward is the accounting period dimension. To make capital budgeting decisions, managers must analyze each project by considering all the lifespan cash flows for its initial investment through its termination. In this example, we can see the relationship between the 2 dimensions. The vertical rectangle is for the 2015 accounting period. For example, represents the dimensions of income determination and return annual planning and control that cut across all these projects that are ongoing in the year. This is example 21-1 on page 803 in your book. As you can see, Project M 2015 is started in 2014, is carried over. Project N, as in Nancy, is going to finish up in 2015. Project O is in the middle of its lifespan, and Project P is getting towards the end of its lifespan. Managers use the capital budgeting as a decision-making and control tool. Like the 5-step decision process that we have studied throughout this text, there are 5 stages to the capital budgeting process. Here are the first 3. The first one is identify projects. Identify potential capital investments that agree with the organization strategy. Number 2 is obtain information, which is the gathering of information from all parts of the value chain to evaluate alternative projects. Number 3 is make predictions. In this case, the forecast all potential cash flows attributable to the alternative projects. Number 4 is make the decision by choosing among the alternatives, which is determine which investment yields the greatest benefit and least cost to the organization. Now, number 5, implement the decision, evaluate the performance, and learn. They are generally separated into 2 phases. The first phase is to obtain funding and make the investment selected in stage 4. And the second phase is track realized cash flows compared against estimated numbers and revised plan if necessary. New products often require additional investments in current assets, such as inventories and receivables. Working capital in this chapter refers to the difference between current assets and current liabilities. Any additional investment required for the project will include in that project's cash flow. We have four budgeting methods to discuss. The first one is the net present value. Second one is the internal rate of return. The third one is the payback period. And the fourth one is accrual accounting rate of return. Methods 1 and 2, the NPV and the IRR, are discounted cash flow methods. Discounted cash flow methods measure all expected future cash flow inflows and outflows of a project discounted back to the present point in time. The key feature of a discounted cash flow methods is that the time value of money, which means that the dollar received today is worth more than the dollar received in any future time. The reason that $1 received today could be invested at, say, 10% per year so that it grows to $1.10 at the end of year one. The time value of money is the opportunity cost for not having the money today. DCF methods use the required rate of return, which is the minimum acceptable annual rate of return on an investment. The RR is internally set, usually by upper management, and typically represents the return that an organization could expect to receive elsewhere for an investment of comparable risk. The RRR is also called the discount rate, hurdle rate, cost of capital, or opportunity cost of capital. The NPV method calculates the expected monetary gain or loss from a project by discounting all expected cash flows, inflows, and outflows back to the present point in time using the RRR. Based on financial factors alone, only projects with a zero or positive NPV are acceptable. We'll see 3 steps of the NPV method. Step 1 is to draw a sketch of relevant cash inflows and outflows. See right to side of next slide. Step 2 is to discount the net cash flows using the correct compound interest table from Appendix A and sum them. Step 3 is to make the project decision on the basis of the calculate NPV. Zero or positive should be accepted because the expected rate of return equals 0 or exceeds the required rate of return. As indicated on the right-hand side of the spreadsheet, shows the sketch of relevant cash flows for the period by source. Column C represents the appropriate compound interest factor to use, and column B represents the sum of those cash flows. In this case, the cash flows from the project are adequate to recover the net initial value investment in the project and earn a return greater than the required 8% for this example per year on the investment tied up in the project over its useful life. Managers must also weigh non-financial factors such as the effect of the project will have the employees, the brand, and other areas of business. This is example 21-2 on page 807 of your book. The IRR method calculates the discount rate at which the investment's present value of all expected cash flows equals the present value of its expected outflows. We are looking here at a rate of return that makes NPV equals 0. A project is accepted only if the IRR equals or exceeds the RRR. Managers or analysis solving capital budgeting problems usually use a calculator or computer program to provide the internal rate of return, but a more manual trial and error approach can also provide the answer. Now, when I talk about the trial and error approach, we use the discount rate and calculate the project NPV. The goal is to find discount rate for which NPV equals 0. If the calculated MPV is greater than zero, use the higher discount rate. If the calculated MPV is less than zero, use the lower discount rate. Continue to use the discount rate until the MPV continue until the MPV equals zero. Computing the IRR is easier when the cash inflows are constant. Here's a look at the calculation done for IRR. This is example 21-3 on page 808 in your book. MPV is generally preferred because its use leads to shareholder value maximization. MPV is expressed in dollars, not in percentages. IRR projects cannot be added or averaged to represent the IRR of a combination of projects. The MPV value can always be computed for a project. MPV method can be used when the RRR varies over the life of the project. IRR is more prone than the MPV to indicate erroneous decisions. The IRR implicitly assumes that the project cash flows can be reinvested at the project's rate of return. MPV accurately assumes that project cash flows can only be reinvested in the company's required rate of return. Still, the IRR method is widely used. The payback method measures the time it will take to recoup, in the form of expected future cash flows, the net initial investment in a project. Like the MPV and IRR method, the payback method is not distinguished among the sources of cash flows. Shorter payback periods are preferable. Organizations choose an acceptable project payback period. Generally, the greater the risk, the shorter the payback period should be. The payback method is easy to understand, but there are two weaknesses in the payback method, which are it fails to recognize the time value of money and doesn't consider the cash flow beyond the payback point. When uniform cash flows, initial investment divided by the uniform increase in uh, annual future cash flows. So when you have uniform cash flows, you're just going to take the net initial investment divided by the uniform increase in annual cash flows. When non-uniform cash flows are involved, you add the cash flow period by period until the initial investment is recovered. Count the number of periods included for the payback period. It is relatively simple to adjust the payback method to incorporate the time value of money by discounting the expected future cash flows before performing the calculations. The AARR method divides the average annual income of a project by a measure of the investment in it. That measure of the investment in the project can vary company by company. It is also called the accounting rate of return. The accrual accounting rate of return method is similar to the IRR method in that both calculate the rate of return percentage. However, the IRR method is generally regarded as better than the AARR method. The AAR method formula takes the accrual accounting rate of return equals the increase in expected average annual after-tax operating income divided by the net initial investment. The formula of Remember that the value used for the denominator can vary, so be sure you understand how the AARR is defined in each individual situation. Some of the advantages and disadvantages of the AARR method are: firms vary in how they calculate the AARR. It is easy to understand and uses numbers reported in the financial statements. It does not track cash flows. The disadvantages are: it does not track cash flows, it ignores the time value of money, and when different methods lead to different rankings of projects, more weight should be given to the MPV method because the assumptions made in the MPV method are most consistent with making decisions that maximize the company's value. One of the biggest challenges in capital budgeting, particularly DCF analysis, is determining which cash flows are relevant in making an investment selection. Relevant cash flows are the differences in expected future cash flows as a result of making the investment. A capital investment project typically has three categories of cash flows. The first one is the net initial investment. The second one is after tax cash flows from operations. And the third one is after tax cash flows from terminal disposal of an asset and recovery of working capital. We'll look at each category, but let's be sure we understand the effect of taxes can have on cash flows. In this example, we can see the effect of our sample company, Vectors, who is considering the purchase of a new bus. A significant characteristic here is the non-cash nature of depreciation expense, which decreases taxable income. This is example 21-5 on page 816 in your book. Three components of the net initial investment cash flows are the initial machine investment, the initial working capital investment, and the after-tax cash flow from current disposal of old machine. Two components of cash flows from operations. The first one is the annual after-tax cash flows from operations, which is excluding the depreciation expect. And the second one is income tax cash savings from annual depreciation deductions. For economic policy reasons, tax laws specify the depreciation methods and which depreciation lives are permitted. When there is a legal choice, take the depreciation sooner rather than later because this will increase the project's NPV. The disposal of an investment generally increases cash flows of a project or cash inflows of a project at its termination. Two components of terminal disposal investment is the after-tax cash flows from terminal disposal investment and the after-tax cash flows from recovery of working capital. We have looked at ways to identify relevant cash flows and techniques to analyze them. Our final stage of capital budgeting, stage 5, is the implementation and control of the project and the evaluation of performance. Implementation and control includes management of the investment activity itself and management control of the project as a whole. A post-investment investment audit may be done to provide management with feedback about the performance of a project so that management can compare actual results to the cost and benefit expected at the time the project was selected. A post-investment audit may prevent managers from overstating the expected cash inflows from projects and accepting projects they should reject. Companies should perform post-investment audits with thought and care and only after the project outcome are fully known. There is an inconsistency between using MPV method as best for capital budgeting decisions and then using a different method to evaluate performance. Even though MPV is the best for capital budgeting decisions, managers will be tempted to make the decisions based on the method on which they will be evaluated. A company strategy is the source of its strategic capital budgeting decisions. Managers can use the framework described in this chapter for project evaluation and also make strategic decisions about which customers to invest in. Some firms regard R&D projects as important strategic investments. Some of the terms that you need to know in this chapter include the accrual rate, accounting rate of return, or AARR method, capital budgeting, cost of capital, discount rate, discount cash flows method, discounted payback method, hurdle rate, inflation, internal rate of return method, the net present value method, the nominal rate of return, opportunity cost of capital, payback method, real rate of return, required rate of return, and time value of money. I encourage you for each of the chapters for this last test to take each one of these and write out the definition and have these as part of your notes. Again, if you have any questions about the information that we presented in this chapter, do not hesitate to ask. The word for this week will be Christmas. Thank you and have a great day.